Imagine this. It's the early 2000s, and the housing market is on fire. It's like a real estate frenzy, with homes being snatched up left and right. People are buying houses they can barely afford, thinking that the prices will keep going up forever. It was a time of exuberance, dreams of wealth, and seemingly endless prosperity. But as we all know, what goes up must come down. And in 2008, the bubble burst, sending shockwaves through the entire nation. It was like a seismic shift in the real estate landscape. The market that was once soaring to new heights suddenly plummeted, leaving behind a trail of devastation. Now you might be wondering how this crash happened in the first place. Well, it all started with a combination of factors. Easy access to credit, low interest rates, and lax lending standards created a perfect storm. Banks were handing out mortgages like candy, even to borrowers with questionable credit histories. And these mortgages were often bundled together and sold to investors as mortgage-backed securities. But here's the kicker. Many of these mortgages were subprime, meaning they were given to borrowers with poor credit. And when the housing market started to decline, these subprime borrowers were the first to default on their loans. Suddenly, the value of mortgage-backed securities plummeted, leaving investors with massive losses. The effects of the housing crash were far-reaching. Families who had bought homes at the height of the market suddenly found themselves underwater, owing more on their mortgages than their homes were worth. Foreclosures skyrocketed, neighborhoods were decimated, and the ripple effects were felt throughout the entire economy. But amidst the doom and gloom, there were lessons to be learned. The housing crash exposed the flaws in our financial system and highlighted the need for stronger regulations. It was a wake-up call for the entire country, a reminder that unchecked greed and irresponsible lending practices can have dire consequences. In response to the crash, the government implemented various measures to stabilize the housing market. Programs were introduced to help struggling homeowners modify their mortgages or refinance at more affordable rates. Regulations were tightened to prevent predatory lending practices and ensure greater transparency in the mortgage industry. Over time, the housing market began to recover. Prices stabilized, foreclosures declined, and confidence started to return. Today, the United States housing market is once again thriving, albeit with a more cautious approach and greater safeguards in place. So why should we care about the housing crash? Because it serves as a reminder that we must be vigilant and responsible in our financial decisions. It teaches us the importance of prudent lending practices, proper risk assessment, and a healthy dose of skepticism when things seem too good to be true. The housing crash was a pivotal moment in our history, one that reshaped the lives of millions of Americans. It showed us that even the most stable and secure investments can falter, and that the consequences can be far-reaching. In conclusion, the housing crash was a cautionary tale, an important chapter in our economic narrative. It reminds us to learn from our mistakes, to tread carefully in times of excess, and to prioritize the well-being of individuals and communities over short-term gains. Let us remember the lessons of the past as we move forward, building a stronger, more resilient housing market, one that ensures stability and opportunity for all. I hope you get a very good knowledge from this video. Please hit the like button and don't forget to subscribe.